Hello and welcome to another episode of Be the Bank. Along with our website, FIXnotes.com, the very best place on the internet to learn about the secondary mortgage market. I'm your host, Robert Heitha, and I'm pleased today to bring you the bulk due diligence process and how you can become competitive as a bulk buyer in this space to get the best pricing, the best execution, and build the best relationships with your counterparties. So I'm really excited to jump into today's episode. We got some industry news, we got some recaps on our due diligence process. We've got our portfolio case study. Obviously, we have got our 2 case studies near the end of this show, but then we've also got our portfolio pet project case study that we're gonna take a look at the results through 120 days of ownership. And as you know, you can always skip ahead if you're not watching this live. If you're watching live, please leave a comment on the live chat with any questions for me as we go. If you're watching after the fact, leave a comment as well. We really appreciate it. And you can use the timestamps throughout the course of this video. There's chapter markers so you can jump ahead to the point that is most interesting to you. So let's jump right into the episode. Episode number 41. Happy New Year, everyone. We're going to start with the overview of 2022. We've got some industry events, one industry event I want to mention, and then we're going to talk about this is slightly out of date. This is from last episode's agenda. Our agenda today is bulk due diligence. Then we're talking tech, how you can operate this business from anywhere with a laptop and a cell phone. And then we're going to talk asset acquisition opportunities, case studies, sales and workouts, giveaways, and more. So let's jump right in with the industry overview here. And the first thing first, we're going to talk about the event that's coming up very soon in March, the Distressed Mortgage Expo. I believe that their early bird discount expires February 22nd, so you've got a lot of time, but don't delay because we do have a promo code. FIXnotes will give you a 10% discount over at distressedmortgageexpo.com. So that's in St. Petersburg, Florida. It's a in-person event between March 10th and March 11th. This is really the best event to meet other note investors. Now there's other events like the Mortgage Bankers Association where you can meet banking institutional players looking for larger sources of assets, but this is the best for a starting investor or even a more experienced investor to build those relationships with others in the space. So highly recommend you check out the Distressed Mortgage Expo over at distressedmortgageexpo.com. All right, so I do have a pricing update finally for you. We've won a couple of episodes here without much of a big change in pricing, but we've most recently closed a deal for a large portfolio of first and second liens. It was mostly seconds, so I did want to highlight the fact that we've seen pricing increase in the junior non-performing quadrant here, the 4th quadrant. And just to give you the high-level overview, if this is the first time you're watching this show, we've got pricing based on reperforming loans and non-performing loans. This is the high level. In senior liens and junior liens, when they're reperforming, you price based on yield. When there's more certainty around the asset that you're purchasing, in this case, the cash flow that's going to be generated by the note that you buy, you can be a lot more certain about pricing with regards to yield. And typically in senior liens, you have slightly lower returns. In junior liens, a little bit higher returns, all the way up to around 20%. So that's a 5-year recapitalization on your investment. In junior liens, you break even in about 5 years if you get a very good deal. Now, these days, junior liens are trending more towards those lower percentage points, especially when they are paying via an ACH, automatic clearinghouse, where the borrower is automatically being withdrawn from their account every month, and they're seasoning. So these are loans that have a track record that when they're sold, there's really no expectation of a redefault. There's often equity in those lower end. If you're really looking for these higher yields in both seniors and juniors, gonna have to take on a little bit of risk. Now, what's nice about the secondary mortgage market in general is the risk to reward equation is a lot different than what you'd see in other more liquid and more active markets like equities. Now, when I was in school in my accounting class, I was starting to discover notes and started working for my primary client, US Mortgage Resolution, and they were just so overwhelmed with the fact that we could see these kind of returns in notes secured by real estate. So there was always that question, well, what is the risk? And that's really where you get these higher returns by dealing with more risky deals. Either perhaps there's less seasoning or perhaps you have less equity in the deal. Now, on the non-performing side, we price seniors and juniors a little bit differently. Seniors, we price based on fair market value, FMV, and juniors, we priced on unpaid principal balance, UPB. And the reason we do that is because seniors more often than not resolve through the property, whereas juniors resolve a lot of the times through the borrower. So you can't price a senior based on an unpaid principal balance, especially when it's underwater, because the fair market value of the home is less than the unpaid principal balance. So we price them based on property value. We price juniors based on the debt that's actually owed on the account. And that's where we're seeing the most increase. Our most recent portfolio that we sold, which it actually hasn't sold yet. It's in the due diligence period with our end awarded buyer. So actually next episode in February, we're gonna review the results of that sale. After the due diligence is complete, we'll tally it up and we'll let you know where things stand after closing it. But at this point, it does look like pricing has increased on the top end and the bottom end. Both of those ranges are moving up about 5 points. So let's quickly recap the non-performing waterfall evaluation. So we've talked about this every single episode, I believe, and we've went through in much detail all of the different steps along the way. But what we want to do now before we get into bulk portfolio due diligence is just touch on this one more time so that we can really understand where the bulk side of things fits in context with this individual loan level review. So first we talked about secured and unsecured in episode number 29. We went into more details about how to determine whether a loan is secured and things to look out for, false positives and false negatives when the research that you do doesn't always line up with what you expect. So you have to do a little bit more research in some cases. Then we talked in episode 30 about juniors versus seniors. Once you know if it's in junior position or senior position, you do treat the asset a little differently, as we saw from that due diligence waterfall. I prefer juniors, and a lot of investors, especially in this most recent offering that was both first liens and second liens, the seconds were really, that was the cream of the crop for most of the investors, and that's where they allocated most of the value. Now, next in episode 31, we talked about collateral valuation methods, and I explained the sweet spot here of recently sold comps and why I believe that's kind of the best way if you have the time to do it manually. And it's, you're trading off the time versus ordering from a vendor, but you're also doing a little bit better job than just using an AVM. So I think that's the sweet spot. Then in episode 32, we talked about bankruptcy, chapter 7 versus chapter 13, and how they affect mortgage notes. We also really went into the tactical side of things so that you can review PACER, Public Access to Court Electronic Records.gov, to find the voluntary petition and understand exactly what you're seeing there. Then in episode 33, we talked about occupancy triangulation and how to determine using multiple data points whether or not a property is whether a property is occupied by the borrower who owns that property. Then in episode 34, we talked about O&E, ownership and encumbrance reports, also known as title reports. We went through an actual report, which you can see over at protitleiusa.com, and went through everything that you learned from that report and how to determine, based on that information, your pricing. Then in episode 35, we talked about senior lien status, very specific to junior liens, but also credit is important for both seniors and juniors. So there's a tidbit in here for everybody, even first lien investors. Then in episode 36, we taught you this little nifty formula to stratify based on equity your portfolio into underwater, no equity, partial equity, and full equity. And since you understand this formula, you can also tweak these numbers around to adjust for your own risk tolerances. Then in episode number 37, we talked about property tax research, which is more specific to senior liens because as most junior lien holders or junior lien note investors, note buyers kind of come to take for granted is that senior liens are often escrowing the taxes and insurance. But when you buy a senior lien, you need to make sure that property tax is paid up. Then we talked a little bit more about pricing considerations and what to do when you own the loan to bring those taxes current. So that brings us up to speed throughout the non-performing waterfall evaluation, really more focused on the one-off side of the business, investing in individual assets and going through every single step of the process. But in the bulk due diligence process, we have a slightly different approach depending on how many assets are included in a portfolio. So I often review loan portfolios of at least 100 loans, but more often 2, 3, 4, 500, and even up to 1,000 assets in a portfolio, where you sometimes have to take some things for granted if you don't have the manpower to analyze all of those assets at one time. So what I'm going to do here is go through the steps of the bulk due diligence procedure in high level detail. We're going to get the basics under our belts, and then I'm going to show you how you can access our new masterclass for bulk portfolio due diligence, which is being offered to the mastermind members. So that's currently in development. So I'd be very, very happy to answer any questions that you comment below of course, I'm going to answer them in the comments, but I'll also add even more detail to this new video course as we develop it. So let's get into the bulk due diligence procedures. By the way, I'm going to have this prepared within less than 2 weeks. It might even be ready in a week. And I'll show you what we've got so far at the end of this overview. So the first step is the data review and seller requests. When you get a new portfolio from a seller, one that you've done business with before, or maybe it's your first trade together, the first thing you want to do is look at what you have. And I always recommend note investors to do that right away. As soon as you see that email in your inbox, it takes a short amount of time to open it up, see what you have. If you wait until closer to the bid deadline, and then you finally pull up the sheet and you realize you're missing things, then you're going to be a huge disadvantage to be able to get your bid in time with accurate information calculating your indicative offers. But if you look at it right away, you can quickly determine whether or not you have the fields that you need to go on to the next step of the process. Now, some of those fields are very self-explanatory, like the address and the borrower name and the unpaid principal balance. Of course, if you've signed a non-disclosure agreement, you can have access to those borrower confidential information, like the names and potentially the social security numbers, but that can often be a gray area where many sellers will not provide that information, and they may provide credit reports with redacted social security numbers to let you do your analysis on those credit situations in the trade lines, especially when you're reviewing juniors for the senior lien statuses. But those requests can also be, especially for reperforming loans in the portfolio, things like payment history and payment amount, interest rate, modification date. There's a lot of things that you can look for, and you'll start to get a sense for those when you get these assets under your belt. So for the exact fields that you're going to need to review when you get a portfolio of non-performing or reperforming loans, you got to check out the course by joining the mastermind group. And also you can review assets that we've listed in the mastermind group in the past through our aggregated trade desk to give yourself your own case study as to the data that's being provided in a complete data tape. So once you request that data and you get it back from the seller, you're going to want to start your cursory research and make your indicative offer. So your cursory research, depending on the seller's specific process for liquidating those loans, is going to start with just analyzing the data that's been provided to you. Now, some sellers are going to expect a completely researched bid and making your final offer as your indicative offer, but that's pretty unlikely, especially in the bulk portfolio game. The reason so is because when you're analyzing up to thousands of loans or more, you're going to be spending a lot of money on the complete due diligence. So what sellers do is lock in the exclusivity with the awarded buyer by giving them the indicative bid process to calculate their offers based on the provided data. Now, the onus is really on the seller there to provide good data so that by the time the final bid process is complete, they're not surprised by the new results of the due diligence. So it's really on a seller to give up-to-date information and the best quality data that they can when the tape is produced. It gives an opportunity for the buyer to fade prices and negotiate discounts if they complete their final due diligence and realize that things were misrepresented. So after your cursory research, which is really, like I said, going to be reviewing the equity, the values, the UPB, and the other details like the state-by-state breakdown. You can use the next payment dates to calculate the statute of limitations. You can review some estimated foreclosure costs based on each state. And of course, we're going to get into all of that in the masterclass, which you can join the mastermind group for access to. So you make your indicative offer through a letter of intent. Your letter of intent can be as formal as a Word document or as informal as just typed up in the body of the email, depending on how the seller prefers to do business. Now, I do also recommend giving them a call when you make that offer, just so that they're aware that you're participating and that you're an interested, motivated buyer to do business with. Now, that makes a big difference, either if you call them right when you get the portfolio or when you're submitting your offer, just so you can start that personal connection. Next is the DD vendor orders. So after the cursory research and your indicative offer, you need to submit your vendor orders if you're awarded the exclusivity. And preparing the input files for your vendor orders is a whole nother thing that needs to be addressed with specific requirements for each vendor that you're doing business with. So we're going to teach you in the course how to use title report, title inputs, credit inputs, CoreLogic Credco inputs, which we talked about on the show in the past. And then finally, when you get all that results back, you're going to need to review the output and then add it to your master data tape. And we're going to get into each one of these steps. So I'm going a little quick here so we can drill in just a moment. And then finally, manually reviewing everything that you've got, finalizing that data and closing the deal. If you're awarded the indicative offer, it's your responsibility to follow through with the timeline with your seller to conclude your research and then close the deal as expected. So let's drill into data review and seller requests to get started. So when you get all those initial fields, and we'll talk about what those fields are specifically. I went over a couple of them off the cuff here, but we're going to go through a comprehensive list in the masterclass. You're going to make sure that you have complete data. So not only that the fields exist on the spreadsheet, but that when you scroll down through it or you use a little filter button, that all of the loans, or at least most of the loans, have data filled in. Now you could have all the fields at the top of your header line, but some of the data might actually be missing along the list. So one thing that I like to do, and we'll talk about this in an upcoming slide as well, is sort by unpaid principal balance so you can see the highest value loans first. And if you can make sure that you have all the data on the highest value loans, then sometimes that's going to determine maybe even 75 or 80% of the entire portfolio within just a handful of loans, depending on how the UPB is stratified across the trade. So after that is the address scrub. Now this is something that maybe you can request from the seller if the addresses are just missing entirely. But the secondary step is just to make sure that they're formatted correctly. A lot of times you'll see extra spaces or not enough spaces, or you'll see missing zip codes, or you'll see missing street numbers. Now, on one hand, some of that is easy. I use the find and replace tool in Excel to turn 3 spaces into 1 space. So I can eliminate those extra spaces, which will screw up the data vendors in the next step of uploading your input files. But occasionally you're out of luck because you're just missing the data entirely. So in that case, you can research the owner in a specific county and see if they are referencing any properties, and then you can grab that you can grab that information from a resource like DataTree to plug into your spreadsheet. But if you still can't find it, the best thing is the collateral images. So that's something you can request from the seller, if necessary, to review the collateral images so you can pull those actual legal descriptions and property addresses right off the security instrument, the mortgage or deed of trust. So once you've corrected those unfindable addresses, and I recommend this as a first step because all of your data vendor orders are going to be contingent on good data. Garbage in, garbage out. If you're not updating that information right off the bat, then when you get your data back from your vendors, you're not going to be happy. So next is to notify the seller of your participation in the trade. Like I mentioned, if you give them a call and let them know that you're on it, you're working on it, here's what you need, you've got everything you need maybe, and you're going to have your bid in by the end of the week, something to that effect to make sure the seller knows. Now, many times an email will suffice, but depending on the quality of the relationship you're developing, or depending on how early in the process it is, you might want to give them a call. But to be honest, most of my best buyers give me a call. Most of my best buyers send me an email, and I've done millions of dollars of trades just based on email alone. Of course, we've talked on the phone maybe earlier in our relationship, but once you get to it, people are working fast, and a quick email is often easier than a drawn out phone conversation. Not to say that it isn't important though to start building those relationships. All right, so like I said, you request any need to have data points. One thing you do not want to do as a buyer is bother your seller too much. Now, I've seen from some buyers requests that are super long, that they need these complete documentations all the way back through origination for your indicative offer. That's really not going to fly on a bulk portfolio purchase like this. The need to have data points are the property address, the unpaid principal balance, sometimes the collateral images if they don't have the complete property addresses, and the general next due, last payment dates. The things that you need to have are the ones that you want to request. You don't want to request all of your want to haves. You need that stuff in the final due diligence period, but just to complete your indicative offer, if the seller doesn't have it prepared for you yet, you don't want to make yourself into a problem buyer by requesting things that really aren't necessary in that phase of the process. All right, so let's jump over to the cursory research and making that indicative offer. So like I said, spot checking the highest UPBs is really the most important thing. Ordering by high UPB down, you can see very quickly how high quality the portfolio is, especially if there's some very large UPB loans that really weigh the portfolio into those small bucket of assets. So one thing I like to spot check right away is the secured status. That's the very first thing on our due diligence waterfall, making sure that the portfolio that you're purchasing includes loans that are still enforceable through foreclosure. Now, secured status is as easy as determining property owner versus the borrower name, but can be more difficult, especially with high UPB loans, to really determine whether or not your lien is secured by the subject collateral. So you can also spot check in this process the assignment of mortgages to make sure that the owner that's representing themselves as the seller is actually the owner on title. They've been recorded the assignment of mortgage into their name or their entity's name. And then fair market values, because that gives you a real nice barometer right off the bat of how accurate the seller's information is. So before I even submit my letter of intent, I mentioned you're kind of using the seller's data to prepare that offer, but it's a great idea to spot check fair market values so that you're going in with some knowledge of what the actual fair market value is, and you're not misrepresenting your bid with information that you could have had readily accessible. For example, MLS listing statuses, knowing whether a property is on the market to be sold and how much it's being sold for. That might not be on the spreadsheet from the seller. So as a buyer, it's a great thing, low-hanging fruit to research that can give you a lot more certainty around a specific deal. So next is to run a couple formulas. Now, like I said, when you're analyzing thousands of assets, you need formulas. You need to be good in Excel so that you can analyze from the top down using an option, a control D to fill in the entire cell, or just dragging that little black box in the corner of your cell all the way to the bottom so that you can calculate things like equity coverage. You can use the formula we talked about for the equity coverage tranches. There's so much that you can do with formulas to quickly determine your pricing. And in the course, the masterclass on this, I'm going to teach you a lot more of those formulas that you can use to determine an actual price for every single loan in a portfolio so that you can quickly determine your indicative offer and then fine tune that offer based on individual situations. And of course, those pricing considerations need to meet your goals as an investor. You need to make sure that you can expect some return on your investment if you were to win the bid. So next we've got submitting the LOI. Now I mentioned before this can be as formal as a Word document, you convert it into a PDF, or just an email, in the body of an email with a spreadsheet attached with all of your loan level offers. Now one thing that pretty much every seller is going to specify on bulk purchases like this is loan level offers. No matter what, they're going to need the loan level numbers for the contract. So to submit those in the beginning of the process in the indicative period is going to be required by pretty much every seller who's trading large portfolios like this. So you submit your LOI and then you wait to get your results. Now I like that follow-up call to help build a relationship, but for me, at least as a seller, I respond as soon as I get these offers. As soon as I look at my email, I'm going to reply and say, received, we're working on it. Maybe a little bit of initial feedback depending on where they're coming in or what type of sale that we're running at the time. But a follow-up call, if you don't hear back from your seller, is a great way to continue to build that relationship. So let's jump over to DD vendor orders next, preparing your input files. Now, your input file only really is necessary if your indicative offer is accepted. That's when you're going to complete your comprehensive research to determine the actual situation and the actual prices that you're willing to pay for all these loans. Now, if the seller's data was good, your indicative offer should be really, really close. But to determine, trust but verify, the verification process is that due diligence period. So preparing and submitting your batch inputs is really going to be related to each individual vendor. We've got your secured scrub, we've got your O&E and title report, your credit report, your BPO and your other valuations, and your property tax and HOA review. So each of these different vendors accepts data in a slightly different way. Most of the time it's via a CSV file. Sometimes it's more complicated, uploading a CSV file in a specific naming convention to an SFTP site, which can be a little bit more difficult, but often better data in larger quantities. But most vendors make it pretty easy. For example, ProTitle USA has a secured scrub. You can send the data in a regular Excel sheet with loan numbers, addresses, borrower names, origination amounts, and unpaid principal balance amounts, the origination amount. And then they will match that up against the current property owner. Then they've got a couple formulas internally where they compare the property owner with the formula to the owner on title. Now I've seen some, it's like maybe 80% accurate. So you do need to review those manually, and we'll get into that in the next step. Then other services like TransUnion can offer credit reports to you. If you upload, it is a CSV process, but they do it right in a protected portal. There's no SFTP site necessary, but you do need these certificates uploaded and renewed in your system so that they can verify that you're the person you say you are. So a lot of these more sensitive borrower type of reports, they require some jumping through hoops because we're protecting the borrower's anonymity and being above board as far as how we treat sensitive information. It's very, very important in this business because with credit reports, for example, you can be dealing with thousands of social security numbers, something that's super valuable, super important to protect. And when I say valuable, I mean not that it's valuable in any type of secondary market, but they're valuable to those individual consumers. And that can mean the difference between getting their identity stolen, which is super, super scary, and you need to be very careful protecting that information. Quick note here, I had a laptop stolen from me at a conference. Of course, the laptop is password protected and everything, but it has a lot of very valuable information beyond that password. So in order to have some security around it, I did a remote wipe of that computer as soon as it was found missing. And remotely wiping the entire hard drive was able to protect all of those potentially sensitive information. So you got to have contingencies in place, your own cybersecurity plan so that you can protect this information. So let's jump over to compile results and review the output. So first thing you're going to do when you get these output files is parse through the data that you've received. Now, once again, using the little caret filter button in Excel, you can check down the entire column and make sure that you have all of the individual fields completed across the portfolio. Now, little things like a bad address could give you bad result and just have blanks across every field. But if you've got most of the assets completed and you can tell where the issues are, then it's probably not going to need to be rerun through the vendor. But if you've got a lot of missing stuff, then maybe you do need to re-upload that with correct information. And that's why that address scrub in the beginning is so important to make sure you're feeding good data into your vendors. So once you've made sure you've got everything you need, you've talked to the vendor if necessary to add some more information, then you're going to use a simple formula like VLOOKUP or ordering your list based on the loan numbers, or a combination of the both. And I'm going to give way more detailed instructions in the Masterclass for Mastermind members on bulk due diligence, on exactly how to use VLOOKUP and ordering your list to bring in your due diligence results back into your master spreadsheet to start analyzing those results. So next is to append the vendor data, like I said, into the master spreadsheet. Pretty simple once you understand how to do it, but it is a sticking point for some people. If you get even one asset shifted offline, you could be merging information for the wrong asset into the wrong fields in your Excel sheet, which can just be disastrous to the quality of your data and your final bid. So next is to update your indicative pricing with the aggregated vendor results. You're going to take all the fields, all the information that you've gathered throughout those vendor orders and merge them back into the input fields of your pricing formulas. So in your indicative offer process, you use some specific formulas to create your pricing. Now, everybody has a different way of analyzing values and using a pricing matrix of sorts to put every loan into specific stratification for pricing. But once you get the data from the vendors, you can then update all of the input fields, which will automatically, if you've built it in a way that's robust enough, calculate new pricing across the portfolio based on the new information that you've found. And then we move on to manual review. So to finalize and close the deal, you got to sort the assets not by unpaid principal balance, but by highest offer amount. So in the beginning, we were looking at UPB because that was the best thing that we could really use to determine value for these loans. But once you have your indicative pricing calculated, maybe that top UPB loan was unsecured. You don't really have any reason to have that as a priority triage type of research project anymore. You want to be looking at the unpaid principal balance that's secured at the top of your list, which is most often looking based on pricing, your highest offer amount down. So now you're going to be doing a manual review across each individual loan down the list in order of value as you see it. So reviewing all the pricing inputs manually is a great idea, adjusting as necessary. Maybe you think the fair market value that you've got calculating your equity is a little bit aggressive. You could fade that a little bit. You can look towards your senior lien status for a junior lien investment to make sure that maybe you're pricing 30-day late loans at the same value as current senior lien, and you might want to knock a few points off there. There's a lot you can do on your pricing matrix, which will translate into new pricing across the entire portfolio. But doing these little tweaks along the way can be very, very useful depending on what type of unique contingencies and situations you find in your process. So now we've completed all that data entry with regard to your scrub, but you want to start looking back at your PDFs as well. So a lot of times vendors will not provide all of the data necessary in their spreadsheet. And there's a little bit more in the PDF of the report that you can extract manually, or at least get your eyes on so you understand some other things you may have missed in your more broad strokes review, looking at the entire portfolio using formulas. So looking back at public records, looking at the PDF reports, kind of taking a manual review, starting with the highest value assets first and moving your way down, can be super useful in uncovering things both to increase price and to decrease price, but very, very important to mitigate the uncertainties around potential situations that could occur. So finally, we're going to compare our final offer with our indicative offer. We're going to highlight any material differences to explain to the seller why the price that we're offering after the complete due diligence is potentially less than what we were offering in the indicative process. Now, it's really important to close it as close to that initial price as possible, because if the seller had a bunch of other bids, some of those bids might serve as backup offers, and the seller might say, you've really, you've reduced the price way too far. We need to give another buyer a crack at this to see if maybe they can keep the pricing closer to their indicative number after due diligence. Now, depending on what the material differences are, for example, if a lot of the loans are unsecured and you thought they were secured, that's pretty tough to make any case for. Any other seller is going to do the same thing, or any other buyer is going to do the same thing by reducing the pricing on the loans that end up as unsecured. But for little things like small changes in equity, it's really not in the buyer's best interest to try to reduce the pricing. And another buyer will come along and pay a higher price, just give them the opportunity. So very important to try to inform the seller of your results and then close at the initial price whenever possible. That's my advice. Definitely try to get it done as close to the indicative price as possible. So like I said, we've got this Masterclass new series coming out. We're going to release Masterclass video courses on a quarterly basis, exclusive to the Mastermind group with no additional cost to Mastermind members. As we mentioned, we're starting with the bulk portfolio due diligence, and our bulk portfolio due diligence course looks like this. So this is the initial, not the course yet, but the initial page that you'll see. And bulk due diligence, learn how to analyze thousands of assets efficiently. We've broken it up into these 5 lessons. And these 5 lessons will then be accompanied by videos, by worksheets, spreadsheets that you can use to adapt for your own purposes, and a whole bunch of additional information to really give you everything you need to succeed. So I'm very, very excited about this new process to do these, let me find my presentation here, to do these new Masterclass series. And I think it's a great value add for our Mastermind members, so that there's just one more thing included by joining that can level up their career. So here's an idea for the upcoming. This one's locked in. We're going to complete this one in the next week or two. But some other ideas, we've got efficient and profitable sales processes. I've got a very, very good process for analyzing as many offers as you receive. My last offering was 20 plus investors all making bids, and putting them all in the same spreadsheet and doing it efficiently and being able to determine the highest offer across all of those different bids is something that I'm very experienced with, and I'd be happy to share. So that's going to be one of the potential courses coming up. Then we've got Microsoft Excel for note investors. I think that this can't be emphasized enough. So to take a really deep dive, not into the due diligence type of Excel stuff, but also the portfolio management, the updates that you'll need to do to audit your portfolio along the way. I think this is going to be a very valuable potential course. And then of course, raising capital for large acquisitions. This is going to be another great masterclass, because the main thing that I'm seeing from my community is the disappointment in not being able to compete with these bulk buyers who are able to close $2, $3, $4 million acquisitions, whereas a lot of investors have a sweet spot of maybe 50 to 100,000. So I'm personally not a big fan of raising capital as far as having investors, but I am a big fan of partnering with other note investors to take down a larger trade and then to split those assets up with your group. So that's been a strategy that I've seen a lot of investors use, and to much effect. So that's going to be the main focus of the raising capital for large acquisitions, is really taking it from that angle. But we'll also talk, of course, about raising capital using a pitch book and finding investors that can help fund a note acquisition. All right, so we've went through a whole bunch of stuff already, but I want to just quickly touch on our favorite thing, which is the birds. Let's see how the birds are doing. The camera's already dead since we didn't watch them. There aren't any birds out there, but I did want to show you the fish, which, yeah, they're hibernating. There's no fish for a little while. They've got a little breathing hole and a little heater on the other side of the pond just to keep the ice melted. That part of the ice is definitely freezing over. So no fish, no koi today at the moment. So we're just going to jump right back into some real estate mortgage note content with our next slide, which I think this is a great, oops. Oh, there's our birds. We weren't even looking at the right slide. Yeah, so there are no birds. There's no birds, there's no koi. We saw a bunch of robins this morning, but they were out in the grass, not on the feeder. Okay, so without further ado here, let me jump back over to the portfolio results. So we've been talking about this portfolio that was acquired in September, service transferred in September 2021, 280 loans, about 10 million of unpaid principal balance. And we've been going through each step of the process to see how this portfolio has evolved with regards to our collection process. So right from the start, we saw very small slivers, inbound cooperative, some inbound hostile, and more in the second space, we saw a lot of inbound cooperative borrowers, 8% right in that first 30-day process. In the first 60 days, we saw a little bit of some resolutions achieved, both on the first lien side and the second lien side. Small balance of resolution achieved. After 90 days, those numbers increased. Now we've only got 70% of the junior lien side in the no contact bucket. As you can see, the junior liens are a lot bigger piece of this portfolio, so you're not going to see as many changes on the senior lien side. So now we bring it up to speed. We've looked at those 3 slides in previous episodes. Now we're at the first 120 days. We sent 2 collection letters. The borrowers received the hello letter and the FDCPA letter. So at this point, we've kind of exhausted all of the low-hanging fruit. These are the borrowers who are motivated based on these soft collection letters and the required notices. And at this point, we're seeing only 64% that aren't contacting anymore. We've got a nice big chunk, 36% of the portfolio now, that has reached out. 15% have been resolved. 3% we've received notices but not borrower contact. 4% is inbound hostile, which means they're disputing, they're either debt validation requests or otherwise there's some difficulty coming to an agreement there. And then 14% of the second lien portfolio, based on the unpaid principal balance, are all inbound cooperative, working towards some type of agreement, either modification, payoff, some type of agreement to help them get back to current status. On the senior lien side, we didn't see much changes over here since it is a smaller sample size. But let's drill in a little bit more and look at what those actual numbers are. So we've already seen this one through 30 days. Those changed through 60 days. We found one of the loans was unsecured. Found a couple more loans unsecured in the first 90 days. And at this point, and actually there's a glitch here, I see. Those 4 unsecured loans should have been on this slide. But otherwise, all the information is correct above. So let's look at the 120-day process of, and we're going to skip the first lien since there wasn't much changes from last week. But the second liens, we're looking at 9.9 million that are still secured. We've got a little chunk that turned out to be unsecured, not 99,000, but 134,000. And across the list here, we've got inbound cooperative representing 13.6% by UPB, inbound hostile by 3.7%, notice received 2.9%, and resolution achieved 15.3% of the portfolio. So this is something that can be somewhat used to start to determine a bank portfolio's resolution within the first 120 days is often around 15%. Now, this is not aggressive collections. These are very soft collection letters that say, the sooner you contact us, the better we can serve you with regards to your defaulted loan. Reach out right away. We have way more options available if you're proactive in reaching out. So these aren't demand letters. These are more just, we're here, we want to help, reach out to us and we can see what we can do. So in this sense, these 15% resolution achieved and these 13.6% inbound cooperative are really the sweet spot here, the around 25% plus, almost 30% of the portfolio where there's really high probability of getting a deal done. So let's actually drill into those buckets, the inbound cooperative and the resolution achieved. And we did look at this after 60 days. We looked at it after 90 days, and now we're looking at it after 120 days. So this is just looking at those buckets, resolution achieved and inbound cooperative. And we can see on the senior lien side, 54% of the portfolio is moving in the direction of a potential modification, 14% full payoffs, 14% discounted payoffs, and 18% has already been modified. On the junior lien side, we're seeing 31% as potential modifications, 16% as full payoffs, 9% as discounted payoffs, and then 43% remaining as completed modification agreements. So this is interesting to see, and it's tough to really draw as much of a comparison between seniors and juniors when the sample sizes are so different, but it is interesting to see that most of the portfolio is mods and full payoffs. There's actually only a small amount of discounted payoffs. Now, what I would expect to see in the next 120 days is this discounted payoff percentage increasing, because as we get to the assets that aren't as proactive, that potentially don't have as much equity, you're going to see more discounts, more types of negotiations with the borrowers towards that effect. Now, I do want to mention, I mentioned this earlier on the call, but now that we've executed our loan sale on the remaining loans of this portfolio, not these buckets, but the no contact buckets, we're going to review that in our upcoming episode to see where the value of those remaining assets were, what the prices were, and what can be expected going forward from those loans. So let's look at a couple new charts here. This is the portfolio results from transfer through 120 days using all of the assets in the portfolio. You can see the big red box is no contact, and that slowly gets smaller as we see inbound cooperative, resolution achieved, the notices and the hostile borrowers all increasing or remaining the same, but we can see a lot of increase in the resolution and the inbound cooperative. And this is just the junior liens, by the way. This is, I said all of the portfolio, but this is only the seconds. And let's drill in, let's get rid of that red just so we can see a little bit easier here. Inbound cooperative versus resolution achieved. We can see between 30 and 60 days, the inbound cooperative went down a little bit as some of those turned into resolution achieved. And then going forward from there, we see both of them are going up. Some loans are cooperative and resolving, and others are becoming new cooperative loans that are sometime going to resolve in the future. So this is looking at unpaid principal balance across the portfolio and really identifying that 30% where this is about 30% here, the resolution and the inbound cooperative together, that have been the low-hanging fruit, we would say. The borrowers that are cooperative, that are motivated and proactive in reaching out and getting a deal done. So now that these loans are in the process of being sold, not these loans, but all the red loans, we're going to see the new owner of those assets escalate the collection process just a bit. Now, some borrowers will still be low-hanging fruit here. In fact, there's a couple of inbound cooperative borrowers that were identified during the sale process and are going to remain they're not in red on this chart, but they're going to remain in the portfolio that's being sold. So the new buyer has some low-hanging fruit right off the bat. Their own RESPA and FDCPA notice letters are going to knock down some fruit as well. These borrowers who are proactive are going to get those new notices and say, hey, I slipped my mind when I got the notice last time. I'm going to reach out to the new lender and get a deal done. But then the next step from there is demand letters and escalating the collection process somewhat. So that's it for our pet project here, the portfolio review. And this is really the conclusion of the resolution side of the business. And then the next step is going to be the sales side. As you may know, my primary clients, their objective is normally based on this trading and velocity model, where we work on the portfolio, dealing with the borrowers who are really motivated to get their trades complete, to get the properties sold and paid off or under modification agreements. And then we work with investors who are better suited for the next phase of the collection process, sell the loans that haven't yet reached a resolution status, and then recapitalize, buy new loans, help more borrowers, and then complete that process again with our downline, people who are either local to the specific markets or better suited for taking back properties, often through the deed in lieu of foreclosure process, not necessarily a foreclosure, and then helping those borrowers pay off their loans through short sales and other exit strategies. So let's jump into our next phase of the call, which is tech tips. And I love this business. Oh, you're not looking at the screen. I love this business because we can run it from anywhere with the correct hardware and software. You really need a good computer, a decent phone, and an internet connection. But using all these different web services, you can connect the dots and really make this business operate from anywhere in the world. Now, I love Podio. We built our mastermind group on Podio, so you can get a taste for it by joining the mastermind group. And there's so much you can do from the free version up to the paid version when you connect it to the workflow automation product. And that is, I think it's only like $30 a month, and it really lets you automate all of these other web services and push them all back into Podio so that you can automate so much of your business in a way that makes life a lot easier. And I always recommend, we talked about this in previous episodes, just start with the technology and then make the hires. The thing that's really difficult for the big companies out there who've found efficiencies through technology is they've had to lay off hundreds, if not thousands of employees when the technology does things better. But if you do it in the right order, nowadays you can start with the technology and then hire people to fill in the missing spots. That makes so much more sense because it creates longevity for the employees, job security for them, and teaches them a skill of how to leverage the technology in their own way. So I think it's very important to start with all these services and software solutions. Of course, Excel is going to be so critical, and that's going to be a big focus of our upcoming masterclass bulk due diligence process for our mastermind members. All right, so I'm not going to go through every single one of these. We've done that many, many times before. So we're going to jump right into asset acquisition opportunities and then case studies. And to be honest, I don't think I updated this assets for sale slide. I definitely didn't. So this next offering has already happened. The Q1 offering happened in Q1 as expected. We thought it might get delayed until February, but we've already completed it, which is great. And at this point, the best opportunity for new portfolio is through the mastermind group. And we just got a comment from Ben. Rob also has a great mastermind membership. Highly recommend it. Thank you so much, Ben. Ben's a member of the mastermind group, and he just joined. We got him in like 2 weeks ago, I think. So he's really, really digging in, learning everything in the all of our recorded Zoom calls and all of the other resources that are available. Ben's also helping me as a community manager, so it's good that he chimed in here so I can introduce him informally here. He's going to be helping in a larger capacity in the mastermind group to add value. So I'm very excited to share with Ben here about the masterclass that we're going to be launching soon. So we'll have to talk about that soon. So anyway, the aggregated trade desk, we're now up to well over $18 billion of unpaid principal balance included for mastermind members across the entire industry. Now, not all of those 18 billion of loans are available currently, but a lot of them are available, and including the loans that we're looking to sell right now that are in the final due diligence period with our bulk buyer. Many of those are going to be listed back on the mastermind aggregated trade desk for one-off purchases from other members of the group. Some of the loans might not fit the buyer's strategy perfectly, or they might not be in the right states. So they are going to be liquidating some of those loans. If you join the mastermind group, you can have access to that. All right, let's jump into the case studies here. And let me give us a little bit of background music for a sec. Our next case study, non-performing seconds, secured by a single-family residential home that was resolved with a full payoff of $200,000. All right, no more music. So this first case study, we're going to be talking about had a fair market value of $627,000, a senior lien balance of $330,000, equity that leaves us $297,000 of equity, protecting our $200,000 balance. So as you can see, this is a full payoff at the principal amount. Now, this non-performing loan costs almost 50% of the unpaid principal balance, $99,000 to acquire this one. And as you know, there's 3 questions we ask when we get in contact with the borrower. What happened? Where are you now? And what do you want to do? These 3 questions frame the rest of the conversation so that we can craft a resolution that works for them, that's sustainable, and can get them out of default and get us paid again. So in this case, the primary borrower passed away. The daughter is helping her mother, the co-borrower, resolve their finances and sell the property. So that's what we'll see here. The property was listed for $700,000, over that actually, I think it was $730,000, but did not sell. So they're relisting it with a new realtor soon, and the property is currently vacant. They're going to clean it up, get it back on the market. So they understand that the principal balance on this loan, it was originated at $200,000. They never paid it down. It's still a $200,000 loan. And they want to make sure that it's brought current while they market the home for sale so that they don't accrue any additional interest in the deal. So we came up with an interest-only plan. They couldn't afford a properly amortizing loan, which pays down the principal balance over time. So an interest-only plan gives them the ability to keep the loan current. The balance stays at $200,000, but they're able to start making payments that are more affordable to make sure that they don't stay in default. So in this case, we had a 1 year at $650 a month, 1 year at $750 a month, and then the third year at $1,000 a month. And they wanted to do that deal. They agreed to the interest-only modification to start in July of 2020 after the loan was acquired back in 2019. And the loan was paid off in January 2021 to avoid the step rate increase. So they were going to see the increase from 650 to 750 in July of 2021. And they beat that by 6 months and were able to sell the property and pay off the loan in January. So over 15 months, we went through $1,255 of expenses to get to a payoff of $200,000. That incorporated our due diligence, our onboarding, and our collection process. And a couple takeaways for us on this deal. First of all, sacrificing short-term cash-on-cash returns can help maximize your total internal rate of return when dealing with high-quality collateral and diligent borrowers. After one call with this borrower, we knew that they were going to be a great borrower to work with. They were on top of it. They were getting a new realtor because they weren't satisfied with the first one. They're really trying to get things back in order. And because of the equity in the property, we were confident that they had something to lose here. They were definitely going to follow through on what they said they were going to do. So in this case, if we were forcing a position where we needed the loan to amortize, you needed to pay over probably $2,000 a month and they couldn't afford it, then what are we going to do? Go through the foreclosure process, spend money on legal, fight with them over something that could be as easily avoided as preparing a affordable monthly payment for them, and then the expectation of that payoff down the line amicably. So that's really always our goal, is to work with the borrower, not against the borrower. And although the cash-on-cash return between July 2020 and January 2021, when they paid it off, wasn't huge, and we'll calculate that in a minute, it was still worth it for the internal rate of return when that full payoff came in January of 2021. So we've talked about step rate modifications before, and aligning interest with your borrower with that increasing step rate modification can accelerate the eventual full payoff. Because if the borrower sees that they've got an increase in their interest rate, which subsequently means more of a payment going forward, everybody's on the same page. They need to refi that loan with a new lender or sell the property to get it paid off sooner. Now, interest-only loans are a little bit of a tricky thing because on one hand, they're just paying interest, and that doesn't really seem fair in a way. But I will tell you, as an investor myself, I have signed interest-only loans. I believe that interest-only loans are a great tool to use to either mostly manage your cash flow. So for a rental property, using an interest-only loan can maximize the cash flow while you repair the property and eventually refinance out that interest-only loan. For a borrower situation, the alternative being to stay in default, an interest-only plan is really a win-win for everyone. They can keep the loan current, they can work towards a refi or a sale of the property, and the step rate just keeps everybody on the same page as far as the urgency. There's no prepayment penalty. They can pay it off at any time. That's the main difference, I think, from an institutional lender and a private mortgage investor. Private mortgage investor just wants to get the payoff completed, and they'll take that no prepayment penalty at all. Whereas a big bank, they want to keep their money deployed, and if you try to pay off a step rate interest-only modification early with a bank, you're going to get hit with the prepayment penalty because they're counting on all of that interest. The reason we have that advantage as secondary mortgage note investors is because we don't buy a principal amount. We buy at a discount. We buy, 50% discount in some cases, where we can afford to cut a little bit of slack for the borrower. Now, like I said, the return was a little lower for the cash flow on this, 7.7% cash on cash return in that first year. Now that would go up to around 10%. But in this case, it was paid off a lot sooner, and we hit that internal rate of return of 80+% when that payoff was completed in January of 2021. So I'm happy to say with our case studies, I've just uploaded another 100, 200 plus resolved loans into our Mastermind repository of future case studies. And all of those case studies now we're going to start reviewing in the new year. So we were looking at case studies from like 2019, 2020. Now we're looking at 2021 and onward. And a question from Ben regarding the MPL cost of $99,000. Do you recall the due diligence scenario and the data which helped to determine the initial price? Great question, Ben. Yeah, actually and you can see it here. You first saw, oh wait, no. My mistake. So the senior was $330,000. This is the senior that we determined after speaking with the borrower and getting the senior lien payoff quote. Before that, take a look at this. It changed and I didn't even realize, but it's great. great opportunity to highlight here. Before that, it was only $209,000. We thought the senior lien balance was actually a lot less. Look at that. And it's funny that I left that in because it actually worked out. The $209,000 senior balance was actually, we thought it was higher equity than it ended up being. So that's part of the consideration. We also, because the property had an MLS listing of over $700,000, we thought there was even more equity than that. So the one thing I'll mention about pricing in this case, two things. One is that it was part of a bulk acquisition, so pricing was more affordable than if this was a one-off. And two, this was back in 2019 when it was acquired, and pricing has substantially increased between then and now. So what I will say though is that we knew that it was an equity loan when it was purchased. We had a good feeling that it was senior current, and pricing for a loan like that in today's market would be upwards of 60-70% of the unpaid principal balance. And that's what we'll learn in our next episode in February when we review the results of the most recent offering of loans for sale. So short-term return, internal rate of return, and let's jump on to the next case study. That was case study number 79. Now we're on case study number 80. Case study number 80 is a non-performing first lien secured by vacant land, and it was completed via a short sale for $54.12. So this is a very minimal deal compared to that $200,000 payoff. This was a $5,412 exit. We had a fair market value of $14,500. HOA, there was no taxes. The taxes were current, but the HOA was owed $7,546, which left only $6,954 of equity, covering a $36,732 UPB. So this one was way underwater, $30,000 underwater. And in this case, we bought the loan for 10% of the balance, but that worked out to 53% of the equity. And it turns out the property was worth even less than we thought. So let's get into a deal that's not quite as rosy as that last one. Of course, what happened? Where are you now and what do you want to do? Now, in this case, the borrower and the co-borrower were in a bitter dispute. So I remember I just went back to my email string when I was preparing this and just looking at the back and forth between these borrowers. They didn't even want to talk to each other. So they were arguing through me, essentially. And one of the borrowers was not interested at all. They said, you know, they're not going to help. They're not going to do anything. The other borrower was super helpful. They wanted to do the right thing. And that borrower who was willing to work with us, they knew the vacant land wasn't worth what they borrowed. I mean, in this case, it was worth about half of the principal balance, and they thought that was even optimistic. And as you'll see, it ended up selling for $10,000. So they're working with a realtor. We did get the co-borrower to sign off on the MLS listing agreement, which that was one of the most challenging parts of this process. If there was just one borrower, we just need one signature, get the property on the market. But because there was two owners of the home, the vacant lot, they needed both signatures to get the thing listed. So we worked with this realtor, a long marketing process, knocking down the price by $1,500 every couple of months. And eventually we finally got to $10,000, the best offer. One little tidbit here, we did reach out to the contiguous lots, the other owners that were in that same area, to see if they wanted to buy the lot next door. Can be a really, really good strategy, but unfortunately they offered like $2,500, so it didn't really make a lot of sense. But we did find a buyer for $10,000, and we're going to accept a short sale. So the HOA was discounted. We reached out to the HOA directly and said the property's worth a lot less than the borrowers took out on the home. We're trying to get everybody paid here, but we're all taking a discount. And the Homeowners Association did accept a discount. Not a huge one, but a little bit. So this one took 22 months, cost over $600 to get here. Now, all things considered, that expense was pretty low. A vacant land lot like this is going to be pretty low on the triage list, the loans that you're really spending time and money on. So this kind of was on the back burner. We were working on it, but those expenses we kept down, which was fortunate in this case. So let's talk about these takeaways here. The co-borrower dispute could have been easily clarified, and this was really the co-borrower saying, hey, I'm not doing anything. I don't owe you money. I'm not your client. And I did explain that, no, you signed the note, you are liable for this. And if you don't sign the MLS listing agreement, you could be subject to the deficiency balance. If you don't want to help us sell the home and discount the money that you owe, you could be liable for the whole balance that's owed. So that's an important part of the short sale. We release the deficiency balance. We're not going to continue to pursue the debt that's still owed. And in this case, we did get the borrowers to get that signature. So that was important to get to the next step of working with the realtor. So important thing to mention here, maybe somewhat of an oversight on the due diligence of this one. You really need to calculate your non-performing loan first. Your first lien offers based on equity, not principal balance. Now we did do that, but the equity was a lot less than we thought. So if you're looking towards a property exit, and in this case, a short sale is an exit through the property, not an exit through the borrower, then you need to price based on that as a potentiality. So a short sale here was the path of least resistance. We were able to monetize the loan. Not a big win, but it was profitable. It wasn't a loss, which I think at the end of the day is saying something on a deal like this. So HOAs and often townships, as a final takeaway here, can be negotiated to reduce the balance owed. They call it soft costs and hard costs. And often all of the soft costs can just be written off. Those are costs like fees and penalties. Hard costs are like people going to the property to mow the lawn, or really specific payments of certain types of fines that require actual man hours to complete. So in this case, the HOA was able to write off all those soft costs, not all of them, but discount them substantially and get the balance down to a point where we could get a small payoff here. The borrower was able to get out from under their debt and their HOA bill. So in this case, the non-performing loan payoff return was a 25% IRR. So even though it took 22 months and it only made, $2,000 or so, $1,800, on the non-performing basis, the purchase price, $36.73, that was a 25% internal rate of return, which at the end of the day isn't so bad. So that's what's great about the note business. Sometimes the worst case scenarios can play out in a way that is still profitable. In this case, probably the biggest thing that we lost was time that could have been spent on higher payoff type deals. So that's it for our case studies. Let's get on to giveaways here. Of course, we've got 15-minute consultations available to each and every one of you. If you want to just head over to robbymax.youcanbook.me, you can get on my calendar. And I'd really appreciate if you subscribe to this channel, like the video, and leave a comment. Be happy to answer any questions that you have in the comment section and any feedback that you have on our masterclass schedule. If you have a specific topic that you'd like us to cover for our Mastermind Masterclass, we can add that to the calendar instead of the tentative schedule that we put together. So leave a comment with any feedback like that. It would be very appreciated. Okay, so our upcoming schedule here. We've got our mastermind call coming up next Wednesday. It's the first Wednesday of the month. Then we've got our final Wednesday Be the Bank episode coming February 23rd. That's going to be a good one because we're going to talk about the recent loan sales. And that is it for today's episode. Oh yeah, I do have to pitch the mastermind, of course. Check out our website. Resource for the industry. Check out the mastermind for savvy entrepreneurs and consult with me for your success. The mastermind membership is going to eventually be $990 per month. We actually just had a price increase from $110 to $120 per month because every 10 new members that join, the price goes up by $10. So we've just filled 2 seats at $120 per month. And we'll have 8 more available at this current price before moving up to $130. And if you are a mastermind member, not only do you get access to the entire new Masterclass series of video lessons that we're producing, which are coming soon, but you also get 50% off consulting rates. So that's it. The mastermind group is the best value in the industry to network, to provide tools, to provide acquisition opportunities for you. And if you join, you can get on our next call live next Wednesday, or if you join later, you can get the recordings of all of our Zoom calls. We've got 14 after this next one. So highly encourage you to check that out. It's a money back guarantee too. So check it out, absorb the content in the first 30 days. If you're not happy, send you back a refund. If you're already a mastermind member, you can get over there, podio.com/FIXnotes/mastermind. And if you are not a mastermind member, go to FIXnotes.com/MNM and check it out. That's it for today's show, everybody. As always, be the bank for the industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways, and so much more. Be the bank last Wednesday of the month. We'll see you in February. Did I say that right? February. We'll see you in February, everybody.
you.